and something more substantial?
Well, it's hard to tell at first, but I think that, a bear market rally is just a little bit of a relief rally or a position-driven rally, driven more by kind of selling fatigue than anything else. I mean, I think what's interesting now is that, the question is, where will the market bottom? When will the market bottom? I think the range of outcomes is actually, the floor on the market is actually, not as horrific relative to today's levels as one might imagine. So here we are at around 4,000, and we calculate that a floor on the market is 3,200, even in a recession case. So I think the idea here is pick your spots. Maybe we're not at the absolute bottom, but there are some areas within the equity market that are likely to be, some of the best opportunities, some of the best entry points that we'll see in this sell-off. So that's
a market bottom at 3,200. I don't think so. Hello everybody, my name's True Demon and I'm the Devil's Stockbroker. The clip that you just watched is a conversation that was going on between Bloomberg anchors and the Bank of America head of Securities and Equity Quantitative Strategy, Savita Subramanian. She was going on to explain that the fears of a recession within the environment are not as severe as what was previously stated on other news and by competitors such as Chase. The argument being that the market has already fundamentally retraced far enough in value that a bottom is within sight, but that there may be some distance yet to fall. Bank of America also issued statements a couple of weeks ago saying that the market will almost certainly recover after it gets back above 3,800, which of course it did last week. The price point of 3,800 is, quite interestingly enough, a very significant point of resistance. But what they have not disclosed is that this current market move is just another rally, the same as what we've experienced in virtually every crash that this country has ever seen, and identical to every other crash that's occurred across the world in other equities markets. It's really no different. The formula is very much the same. And in this video, I'm going to compare side by side the other market crashes that have occurred within the United States that are very similar in certain aspects to what we're experiencing now, since the market crash of 1929 that led to the Great Depression, as well as the twin crashes of 1970s, 2008 subprime crash, and the dot-com bubble. So, without further ado, let's get into it. On these series of 4 charts, what we're actually looking at is what really happens in a true crash in the fashion that we've seen for the last 100 years. We have the subprime crash, which was the most recent one before us. Market down 57% from its all-time high to its all-time low. The dot-com bust in 2000 to 2002, where it fell by nearly 50% from its all-time highs. The twin crashes from the 1970s, beginning in 1969 till 1970, and again in 1973 till the beginning, or till the end of 1974. Both times the market retraced by 40 and 50% respectively. And finally, the granddaddy of all of them, the crash of 1929, aka the preceding crash to the Great Depression. What do all of these crashes have in common with our current market situation right now? Well, as a matter of fact, none of them are identical to our current market situation. In fact, our market situation has factors from all 4 of these series of crashes at the same time, something that's never happened in the history of our markets to date. Here's the inflation year over year for the United States dollar over all 4 of these crash charts. In the crash of 1929, actually during the crash we went through a deflationary period because there was no equity within the entire United States economy, so the dollar, it actually regained buying power. The twin crashes of the 1970s was actually the only major inflationary period. Even during the subprime crash, when the housing market had a 1929 style euphoric buyout and housing bubble, the inflation in the subprime crash still only ever peaked at about 5.5%, which was high at the time, but nowhere near the astronomical rate of 14 and 15% at the high watermark in 1980. Those periods were the only time when we saw inflation rise to the levels that we can even compare them to today, which currently sits at roughly 8.5%. Here I'm going to compare the NASDAQ, which is the tech-heavy exchange and indicator index for the U.S. economy for its technical and semiconductors industry, which during the dot-com era, which this is the index that actually caused the dot-com bust, the NASDAQ actually exploded 3 times its value from 1998 all the way up through early 2000, when suddenly it just stopped going up. It crashed suddenly, consolidated over the course of an entire year, and then faked everybody out, giving back all of its gains by the time it finally hit its bottom by late 2002. Even compared to the subprime crash, there wasn't nearly as much euphoric buying as was going on in the NASDAQ back in the dot-com era. As a matter of fact, in the entire market for the subprime crash, the NASDAQ went up 138% from its low during July of 2006, and only finally stopped once the housing crisis had hit Silicon Valley in California. The reason why we don't have this for the 1970s and the crash of 1929 is because there was no NASDAQ, and obviously we didn't have a tech sector since computers weren't in widespread use at the time. In this factor, we're going to look at the median sale price for U.S. houses in the United States. This is roughly the middle ground that 50% of home sales were going at the time during these crashes. From the time in the 1960s all the way throughout the entire inflationary period, you can see that overall housing values went up throughout the time, and it was a reasonable expectation for the housing to climb at this pace. It went on for about roughly 14 years throughout the entire period, and in that entire time housing had gone up from a median value of around $18,000 to buy a home in the early 60s up to $55,000 to buy a home by 1978. This was a reasonable scale of growth, especially given how bad inflation was at the time. And even in the dot-com bust, you notice that housing only increased in value during that entire time. And that is exactly what transpired throughout all crashes except for 1929 and 2008 subprime crash, which the subprime crash, as many of you who lived through it understand, the entire crash was caused by the complete evaporation of demand in the housing market as a result of bad lending practices that caused the mortgage industry to completely collapse, and the Fed had to bail out all of the major banks, and the lending non-bank institutions ended up just going completely bankrupt. This had a cascading effect that led to just mortgages across the entire financial sector to go worthless, and this was made even more awful by the introduction of derivatives, things such as consolidated debt obligations and the insurance policies, which were used to basically create short bets against these bad loans, bad MBS, and poorly structured consolidated debt obligations. These insurance policies were known as credit default swaps, which the market did not have the liquidity in order to remain solvent, as these credit default swaps were cashed out while mortgage bonds were going worthless. This eventually led to the subprime crash that actually we saw the entire median housing price retrace by approximately 30%. This was the worst drop in the housing market that had happened since the crash of 1929, which we don't have data for because it wasn't accurately tracked by the Bureau of Labor Statistics at the time. We only know from anecdotal evidence and the fact that there were just shanty towns everywhere. We'll never truly understand the scale of loss of equity in American homes from that time, but we have to imagine that it was far worse than what we saw here in the subprime crash, which was already bad enough. Next, we're going to look at delinquency rates, which in both the dot-com bust and in the subprime crash of 2007, we saw that delinquency rates went up. The difference is that the dot-com bust saw an increase of delinquency from 2% up to only 3%, and it happened at the peak of the dot-com bust when margin accounts started to go bankrupt, and it caused a bit of a squeeze in the lending market, and we saw quite a bit of title loan delinquency as well. So mainly people lost cars or people lost out on their brokerage accounts. People didn't lose homes. Whereas when you compare it to what happened in the subprime crash, after delinquency went up from 1.7% up to an astronomical 7.5%, it completely tanked the market. Even if it had only gone from about 1.7% up to 3.25%, and that was enough to create this massive dropout in the market, and all of the equity had just disappeared. When the market finally had prepared for its ultimate crash, the delinquency rates had come out by mid-September in 2008 that were nearly 58%, 60% higher than where they had started at the end of 2006 at nearly 5%. And you saw this single drop in value during the subprime crash that completely cratered the stock market, and this was the moment that all of the banks began to fail. What is the reason for me telling you all of this? Well, I just want to illustrate exactly the situation in which we currently find ourselves in our current market bubble. All of the previous bubbles that we have experienced since 1929, equity had exploded in massive ways. 1929 was particularly bad because of a massive housing bubble. The boom after the World War I had finished, and so many other events precipitated in the Roaring Twenties, a time of complete excess and easy access to pleasure and goods that led to the eventual crash in October of 1929. What we've experienced is something entirely different. In all of our time, in the whole of our markets, we have never, ever, ever experienced such growth. The dot-com era, up 215% in 5 years. The U.S. subprime crisis, which was preceded by the U.S. housing bubble from 2003 up until 2007, a period of just 4 years, up 100%. The Vietnam era, during which we got off the gold standard towards the middle portion of Nixon's term in the 70s, and before which Lyndon B. Johnson and John F. Kennedy had produced so much wartime resources and sent our astronauts to the moon. Our economy took more than a decade to move by 100%. It took 2 decades to move 200%, preceded by the high water mark of inflation in early 1972. This is our bubble. That in just 12 years, our economy has exploded by more than 5.5 times its previous value at the end of the subprime crash. After only having come out of a brief bear market in 2018, in the beginning of 2019, we moved by 18% our value in just those 3 years. And in just 2 years, our entire economy during a major pandemic moved by 120% its value. When looking at the logarithmic scale, which is a greater way to look at the amount of growth that we've experienced in our time here in the stock market, 1929 stands out as the only time which we've experienced so much growth in just one decade. The dot-com era comes in very closely with the NASDAQ pushing the entire stock market up by 2.5% with the explosion of the economy in just a 5-year period. However, our bubble makes zero sense. We have a massive explosion of equity in the housing market. We have an explosion of the tech sector. We have rampant inflation that is wildly going out of control. And at the same time, we hold more debt than we have ever had in our entire history put together. When you set these bubbles up next to each other in terms of their dollar for dollar growth, we have never before seen such a ridiculous exponential growth curve before in our market. So what is the thing that actually makes our bubble, this massive overinflation of equity value in our entire market, so different from all of the others, and why is this one in particular, I feel, going to be on the same scale as the crash of 1929? Well, for starters, the only time in our previous history that compares to our current inflation rate is actually 1983, when we were on the downtrend from our inflation woes. But that's not actually the direction we're going. We're going far further up, and that is more what it looked like back in 1972 on the way up to an inflation rate of 9%, and we haven't slowed down. Our delinquency rate is at currently an all-time low, but it's artificially low because we've been propping up everybody's debt because of forbearances and just federal relief from the government because of the COVID pandemic. So in actuality, we don't know what the real delinquency rate is. In reality, once everybody actually goes into delinquency, which you can find more data from sites such as Black Knight, where you will find that the delinquency rate is actually rising past more than 3%. You see, total delinquency is down somewhere around 2.8% according to Black Knight. But if you notice, the actual foreclosure pre-sale inventory, that's homes in foreclosure, is actually going up, as well as the foreclosure starts, which are still climbing at a time where it makes no sense for those foreclosure starts to even be beginning. If anything, everybody should have been using this time and this relief to start paying down their mortgages while they had no interest essentially on their homes. And even further, there's been record equity growth. So anybody who is currently in their home that knows that they can't pay their mortgage, they should be getting out. They should be selling, but they haven't been able to. And that can only mean one thing. They're unable to sell, either because A, they have actually owed more on the home than they are able to pay off, or B, they don't have anywhere to go and they can't qualify for a new loan because of the raising interest rates and also the prohibitively expensive cost of new homes because of the rapid equity growth. Equity growth, by the way, which we can measure against inflation, went absolutely freaking ridiculous at the same time. Within the same period of 2 years, inflation has risen by more than 30% at the same rate as the median housing price. So what I'm basically saying, after compiling all of this information and comparing side by side each of these crashes, what am I getting at and what the hell are we going to do about it? At the moment, things appear to be uncertain, at least as far as the mainstream media is concerned. But rest assured that they're making their decisions. They are already moving into their positions. They're preparing for what's to come. And even though on its surface, the data that they present looks good, although they present that we're nearing a bottom, that things can only go so far, that 3,200 on the SPY or SPX index is as far as we can go. We all should be very aware that that is not necessarily the case. So how can retail investors prepare for the coming crash and compare side by side what their current investments are? What do you go long in? What do you go short in? And my strictly amateur non-financial advice to respond to that is to look at the things that people will be in most need of and think of what people will try to cut their expenses with first. At the moment, houses are at their highest prime value that they have ever been in history, and mortgaging has become extremely expensive. Interest rates are quickly scaling towards record levels for the decade, and we're facing an inflation crisis that's going to put the pinch on every single person out there. In addition to inflation now touching 8.5%, we also have extremely high levels of consumer credit card debt as a percentage of total income. The combination of the CDSP spiking up rapidly, the rapid rise of inflation, and personal savings rate of Americans at their all-time lows at a time when the market is the least predictable, the most bearish, while there is negative equity growth preparing to happen in the housing market, and massive increases of interest rates in order to prevent inflation, which is not being effective, all of this is pointing to one thing. There's going to be a massive pinch on everybody middle class and below. Unfortunately, the rich are going to be just fine. They may as well be on another planet. What is going on down here on the ground isn't even going to enter their minds. They aren't paying any attention. And it ultimately never mattered to them anyway. Why would it now? As ambivalent as they are to the problems that are going on around us, that doesn't mean that we shouldn't be aware of it ourselves and prepare for it accordingly. So there are several things that we as the average consumer and retail investors can do in order to protect ourselves. So in order to do that, I'm going to point out several stocks that I think are going to at least perform well in the recessionary environment versus ones which will not, and how you choose to invest, whether you go long, short, or neutral, or go to cash, or whatever you decide to do, it's up to you. But please be aware of what is going on and do your own research and take what follows for the remainder of this video with a huge grain of salt while you go ahead and research this stuff on your own time. One particular thing which I have mentioned multiple times was DRV. DRV is a direction inverse ETF that shorts the real estate market and a few tech sectors. Specifically, it's meant to be a hedge against the XLRE. That's X-Ray Romeo Lima Echo. XLRE is the primary Standard & Poor's index that basically tracks the real estate market. When this goes up, it's because real estate's doing well. When it goes down, it's because it's bad. Right now, it's pretty bad. It's currently hovering at around $41. I personally think that XLRE is going to go much further down in the near term, so I have puts against this going out as far as 2024. The other option that you have is if you're feeling a little bit more risky, you can go long on DRV. I have a video on these two specific tickers as well as other housing shorts that you can go ahead and check out. I'll leave that at the end of this video. Other things which are probably going to perform extremely poorly are lumber companies such as Boise Cascade LLC. Boise Cascade owns a huge swath of land that has usable lumber which needs to be cut down and processed. They're primarily of course, they're headquartered in the Pacific Northwest up in Boise, Idaho. They have tracts of land all over the Pacific Northwest. What is likely to happen is as construction dries up as a result of fewer permits being pulled, something that we're already seeing happening, as demonstrated by the rapid fall of recently requested permits, down from 1.87 million all the way down to 1.69 million permits pulled in the United States just in the last 2 months. As permits dry up, as construction dries up, so too do construction materials, primarily lumber, which is going to put a big pinch on these companies in order to liquidate their assets and to either process the lumber faster in order to sell it quicker, or eventually at some point liquidate entirely in order to get what they can out of their assets in order to avoid going under. Similarly, companies like Toll Brothers and D.H. Horton and Lennar, the big home builders within the United States, they're likely to get squeezed as well because they're not going to be performing while they have a whole bunch of homes in their inventory that were built on spec, speculating that a buyer would come along once the home was built. Unfortunately, they were very wrong, as demand seems to be drying up because there's less mortgage servicing going on. Fewer people are able to qualify for loans. And of course, because of the rapid increase in price of other construction materials, these companies are really hurting, and now they need to get rid of their inventory. And if those houses that they currently have on the market do not sell, they're going to have to drop their prices. For the ones that still have to be finished, they are taking a huge loss on. If these companies get into a position where they need to abandon the projects entirely, that is when the true panic will begin, and we're likely to see these companies start liquidating assets at fire sale prices. It's going to hurt their bottom line massively, and some of them will be lucky to survive. I believe that Toll Brothers is one of the weaker ones, although if you wanted to go for some of the bigger fish, there is D.H. Horton, as well as Lennar. And there are, of course, a few others that are out there. If you want, I have my watch list here with the home builders that are available. You can go ahead and check out some of these tickers that I have listed. Companies that may do well are discount stores and dollar stores, but currently a lot of them are very overvalued, so you have to be really careful about how you approach it. For example, I'm currently long in Ollie, which you can see has done very well in the last couple of weeks, but has not done well during the peak of the pandemic after it came down from an all-time high from nearly $106. It's come down since then. It bounced off of the $38 level and then has since been ripping up towards the skies. Still currently in my positions, very much enjoying what Ollie is doing. Ollie is one such store that takes closeout sales on very cheap goods, takes it off of the hands of wholesalers such as BJ's, as well as Target, Walmart, and other retail centers. They take their inventory, discount it massively, and make huge profit margins, as much as 40% on their product sales. On the other side, you have companies like Dollar Tree, which in the short term have been performing very well, but may be overvalued and are also having trouble with quality control issues of their product, as fewer of their products are actually going out the door. And inflation is even putting pressure on them to raise their prices up from a dollar store, which the dollar really doesn't buy much anymore. And it's kind of stretched thin as far as what it's capable of actually purchasing. And since the purchasing power of the dollar is decreasing, it's really causing Dollar Tree, Dollar General, and companies like it to struggle in order to provide their product. So stocks that are extremely likely to suffer, in my opinion, are anything that is in luxury electronics. And I can't think of a bigger example than that than Apple Inc. Apple is just inordinately expensive. As a computer user, I just think that Apple's products are generally overpriced. But it's objectively factual that they have some expensive products, and their most expensive products like iPhone, MacBook, iPad, so on and so forth. Their flagship products are extremely expensive, and they don't really have as many applications, or at least they're not very popular for offices and business use. So for that reason, I expect Apple to do very poorly and their sales to decline rapidly as this entire recession progresses. The other types of stocks that I expect to do poorly are any that rely on expensive hardware. For example, Hewlett Packard, um, Microsoft as well. Although Microsoft does have other streams of revenue, they do seem to rely pretty heavily on hardware sales, but they are branching out into subscription-based services, and of course they have cloud offerings, so they do have some diversification there. So, got to be careful of that. The other ones that are, in my opinion, very, very likely to have a lot of resistance going into this recession are any stocks which come from companies in fast food or need to have recurring customers coming through with money. Starbucks is a good example. One of the first things that people cut in order to budget is a coffee habit or cigarettes. And Starbucks is, it's the most popular coffee chain in America. They rely on customer foot traffic constantly coming in, buying coffee. If nobody's able to afford a $5 to $7 coffee habit every day, they're likely to cut back and start making their coffee from home. The car industry is also likely to suffer. The cost of new cars as well as used cars are just going up, and what I expect to happen is the repo market is probably going to do very well. Um, Interestingly enough, companies like Carvana, not thought to be doing well, but Carvana recently purchased an auction company that is going to be auctioning off repo vehicles. So that's actually a new potential revenue stream for companies like Carvana, ticker symbol CVNA, and they even had a little bit of a jump today. They've currently been dragged all the way down to $27, which is, interestingly enough, right at their COVID crash peak price. So that brings them all the way back to what they were trading at back in 2018. This company is facing some serious financial hardship right now, but I think that this is kind of an underdog stock, which does have the potential to turn around. If it can survive the initial blow of the recession and start making profit from its new repo car company, then I expect it to do well. As the recession continues to move forward, I expect that oil is going to get more and more and more expensive. But I also expect governments to take action against oil companies because of one, climate change. It's becoming more recognized as a very serious problem. And governments, even the United States, are beginning to really put pressure on oil companies to start cleaning up and moving over to cleaner energy. And some of them simply just haven't built that into their model, or they refuse to do it entirely. And a lot of these oil companies I don't expect to survive as their costs rise and continued regulations just put the pressure on them. Alternatively, cleaner energy, especially those that rely on either natural gas, geothermal, solar, and all other alternative clean energy sources, especially renewable energies, are likely to receive subsidies. And I expect that once the recession has peaked, that whatever companies are surviving that are able to continuously put out power to people's streets and homes, those are the ones that are going to come out of this recovering strongly. Companies like Arcon, Pola, EOS Energy are just a few of the ones that I am looking at. Tesla, of course, is a big contender. Um, Electric vehicles, oddly enough, I'm not the most bullish on. I think that they have some potential, but there's also a lot of competition in that space now. So you've got a lot of them fighting for market share in an already competitive market that's not going to be very flush with cash, and also financing is going to be extremely difficult in the car space. So probably not going to see as many people going out to go find uh, a EV vehicle. But at the same time, with oil getting more expensive, gas getting more expensive, you never know. So there's a lot of factors in there. It seems like a really contentious space. Oh, almost forgot about Big Lots. That was another discount company, a dollar or a discount store that I was pretty bullish on. Lithium energy, one stock in particular that I am bullish on is Snow Lake Resources. They have lithium mines in Argentina. I consider this one to be a pretty strong candidate to turn around some profits. And those are the main ones that I have been paying attention to. There are other things like Bank of America and JP Morgan Chase, big American banks that I expect to suffer greatly during the recession. I expect there to be some huge drawdown. And in addition to those, I expect that the Big Ten stocks that are currently on the SPY's #1 list, just in general, are going to probably have some drawdown throughout the rest of this bear market. They're the first stocks that people look at, and it's where most people's equity is in the market. So just as a result of the entire equity of the market overall being dragged down, I expect these companies to be pulled down overall. But I am particularly paying attention to the bad acting companies such as JP Morgan, Bank of America, Citigroup, Goldman Sachs, and as well as Meta, which is Facebook's parent company, and Google are likely to face some headwinds going into this recession environment. So those are some of the stocks that I am paying attention to, both on the long and the short side. It's kind of a mixed bag right now. Things are obviously chaotic, and I really do wish people the best of luck. If you're not in a position to be investing right now, then honestly, the safest place to be at the moment is cash, so that when eventually things calm down and we have hit a true bottom, that you'll be in a position to buy the dip, because all these markets, they eventually do come to an end, and as long as there's a society with a stock market to buy into, the stock market will recover. um, that being said, it's going to be a little bit difficult for people to predict where the bottom is, but I am unfortunately so bearish on where we currently are standing that I feel like the bottom could be as far down for the SPY as $200 per share, bringing us back down below our 2020 lower levels. I think that pretty much covers it for this video. If you guys got some value out of this, I would certainly appreciate a like. And if you want to come back, please subscribe to the channel, hit the bell icon just to make sure that you're getting notified whenever I do a video like this. Still working on a more consistent schedule, but we'll get there. And as well, if you are looking for further education and just a like-minded community to discuss finance and investments with, Hell's Trading Floor is an extremely friendly community that would be more than happy to welcome you. If you're curious about that, you can visit our link in the description to take you to our Patreon page at patreon.com/thedevilsbroker, and that will take you to our Discord at discord.gg/Hell's Trading Floor. Thank you so much for watching, and I look forward to seeing you guys in the next video. Until then, have a hell of a time in the stock market.